Welcome back to You Heard From the CFP. My name is Matthew Coyle. Today we're going to talk about investors that just won't quit. Let's dive in. Well, there's no other way to say it. 2022 has started off pretty choppy, and it's the worst market we've had since 2008. Very different market, but nonetheless, worst start since 2008. We are now into February of 2022. Feels good to turn the page off of that month. No fun at all, but I'm optimistic for the year, and so it seems is everybody else. I'm going to show you some charts, some very interesting ETF charts, actually. ETFs are exchange-traded funds, similar to mutual funds. They trade differently, but a very large product class. A lot of people buy and sell them. That may show you that long-term investors don't seem to be fazed by this, and how fascinating it is how much money is rushing into the market here in February of 2022 and did throughout the first month of the year. So I'm going to record my screen and just show you a few things. I'm just going to jump right in. I hope you like charts because you're about to get some. So I am going to record my screen and just show some things here. All right, we're going to start off with the VOO. Let's just dive right into the first one. VOO. VOO, if you're not familiar with it, is a Vanguard product, and this is not a Vanguard advertisement, although you'll see some Vanguard charts on here. VOO is S&P 500 Vanguard ETF. It is an SP 500 ETF that's very popular. It's one of the biggest ETFs in the world. So the VOO is what you're looking at here. This is a chart of net inflows and outflows on a daily basis in the VOO for the month of January 2022. And despite how negative everybody was, interest rates pummeling the market, geopolitical events, everything, huge net inflows for VOO. These are long-term investors buying this fund. These are long-term investors making bets on the market, and really a fascinating thing to see when it was so ugly in 2022. People just pouring money into the market through the VOO, which of course is Vanguard. And Vanguard has become one of the largest, if not the largest custodian in the world as far as ETFs and funds. So next one is the IVV. The IVV is another large S&P 500 ETF that, very low cost, lots of people own it. This one, net inflows, outflows, again, huge net inflows on a daily basis. Very little outflows really, except for 1 or 2 weeks. But again, just almost insatiable, the long-term demand for large cap stock, and particularly U.S. large cap stock. The next one is another Vanguard product. It's the VTI, which is the Vanguard Total Index, trades on the ticker VTI. This particular index, again, net inflows. This is a larger index, more broad, but you see this in a lot of brokerage accounts. So huge net inflows on this particular product as well. Now, what's interesting is when you get to some of the bond indexes, you would expect to see net inflows in the bond indexes when we've had a month like we've had. And you don't see that, frankly. You see net outflows, actually. This is the AGG. The AGG is a big bond index. You'll find the ticker. It's just a broad-based bond index that a lot of people use as a benchmark for bonds, and net outflows on that as well. Like many bond indexes. Now, the only bond index I could find, really, the BND, the total bond, had net inflows of about 900 million for the month, which compared to the size of the fund and the size of the market for bonds is not that much money. So BND, net inflows for the month, but you'd expect to see a much bigger surge into bonds than you would have seen in past years. Maybe this is the index fund effect. Maybe this is millennials. I don't know. It's not Gen X's, that's for sure, because we're not big enough to move the market. I doubt it's baby boomers. Who knows? I don't know, but someday we may find that out, but it's not going to be today. So, next one I'll show here is very interesting. It's ETF flows by traders and by investors. This is a very interesting chart. In this chart, you have roughly a monthly chart going back to roughly March of 2020. The white bars in this chart are ETFs commonly used by traders to hedge the market, and the yellow bars or the gold bars, whatever your or orange bars, whatever you want to call them, are buy and hold investors that buy things like VOO and IVV and VTI and that kind of those kind of products. So the products used by traders, lots of outflows in the month of January, but if you look at the inflows in the month of January, absolutely astonishing, the demand, long-term demand for ETFs in the market. People just continue to come into this market. It's amazing, and they don't seem to be fazed by what's going on. So lots of demand for products, and that leads me to my final slide of this first portion, which is by issuer in the month of January. Vanguard took in almost 22 or a little over $22 billion for the month of January in their ETF lines and their as an issuer for their funds and their ETF products. Schwab next, Direxion, ProShares, and on down the line. Absolutely astonishing, the net inflows that these funds are taking, the net inflows that the funds themselves are taking, and they just don't seem to be bothered by the geopolitical events or the interest rate movements. And it's really kind of speaks well for the market for the remainder of the year, I hope. I take this as a good sign, but yeah, very fascinating stuff. So, interesting. All right, so what's going on? Why are people rushing in the market when things are so bad and people are so worried and there's lots going on? Well, there's always lots going on and people are always worried, but one theory that has been thrown out there, and I'm kind of in this camp, is that the markets are being repriced and the markets are being revalued based on a number of factors, and the market is also broadening out because of it. Companies that are high growth companies like the tech companies you've all heard of, they're probably not going to stop growing at some level. Maybe they don't grow as quickly, but the market is definitely broadening out here, and we can look at another couple of charts to show you that. So if you followed the market in any real capacity over the last 10 or 12 years, you know that this value versus growth performance or underperformance of value versus growth has been in a dynamic like this for a long time. You can see it from September 2020 here, where this chart starts. You can also see it if we back out and look further back into the 1990s. You can see it. So this dynamic of value underperforming growth has been there for quite a while. Now what's changing, and certainly changed last month anyway, pretty remarkably, was if you look at another product that Vanguard offers, and again, this is not a Vanguard ad, don't mistake this, but it's just a big fund that is very indicative of flows. The VUG, which is the Vanguard Growth Index, full disclosure, I own this, many of my clients do as well. This particular fund was virtually flat with all of this going on last month. This particular fund was basically flat, about $20 million of net inflows, which is very, very small amount. You compare that to the VTV, which is the Vanguard Value Index, a huge disparity between these two. Vanguard Value would be like financials, healthcare, energy, things like that, banks. So the market, you might theorize that the market's broadening out here a little bit. People are they're starting to buy a little different asset class. They're still funding their large cap growth assets through the VOOs or the S&P 500 indexes of the world, but they're starting to broaden out some of their purchases. I know I have, and I'm actually telling my clients to start doing some of that as well now. And keep in mind that the average bear market, if you look historically, is not that long. The average bear market is about, most bear markets don't last beyond 19 to 20 months. It's rare. We've only had 1, 2, 3 bear markets that have gone beyond 20 months by the common definition. So don't be caught on the sidelines trying to time things is one of the messages I'm trying to give you here. Bear markets are relatively quick. Not that January was a bear market, it wasn't, but when these market events happen, be opportunistic. Get money into investments. The longer the time you're in the market, the better off you are. And it's a relatively short period that the market is down. Most periods the market spends going higher, and most bear markets don't last that long. Most corrections don't last that long anyway. So when things happen like this, it's nice to see investors coming in from the sidelines, putting cash to work. And it seems that the market might be broadening out here, which is nice as well. All right, a couple more things before I go. Let's show my screen real quick, and I'll go over a couple optimistic things we're seeing in the market lately. Money market funds still at an all-time record. Lots of cash on the sidelines waiting to be invested. Not all of that will make it to the stock market, of course, but some of it will, and that's always a good thing. Fuel for the fire never hurts. Inflation is starting to come down, believe it or not. Opposed to what you hear, the 10-year forward break-even inflation rate is forecasted again still to come down. It's been falling. That expectation has actually been falling since November of last year. Lumber prices are down. They've hit another low here recently. The cost of building a home is less than it was a year ago, and the price of gas is again falling, really for the first time in over a year and a half, you could say. So, on that optimistic note, or notes, I will leave you. Thanks again for watching. I appreciate your most valuable asset is your time. Take care of yourself, take care of your family, and stay well. Take care.